What is up, guys and girls, and welcome to DecDoesInvesting, the wealth, investing and finance channel. Before we start, I'd like to ask you to hit the subscribe button to join me on my journey, and also hit the like button to help me out with the YouTube algorithm. In today's video, I have 3 UK stocks that are currently undervalued at the moment and a potential buy at their current price. However, I would like to point out that this video is just for entertainment purposes and this should not be taken as financial advice. As always, you should do your own research before purchasing any stocks, as your capital will be at risk. The first company on my list is Boohoo, which has the ticker symbol BOO and is found on the London Stock Exchange. Boohoo is a UK-based online fashion retailer and was founded in 2006. It specialises in own brand fashion clothing with over 36,000 products. Looking at Boohoo from a financial standpoint, starting first with its share price, we can see that from the 1 year chart that Boohoo is currently at its 52-week high of £3.87 at the time of making this video. Boohoo has been a very resilient stock during this pandemic, and despite it falling when the markets crashed, it is now above its pre-pandemic price and setting new highs. In my opinion, if it can be successful in times like these, then it can go on strength to strength when the economy picks back up again. Now moving on to the shareholder returns, we can see that over a 5-year period, Boohoo has returned 1,333.7%, which is incredible and is over 10 times that of its industry, which returned 153.5%, and also it feels a bit embarrassing to even mention the market, which only returned 12.9%. But even on the shorter metrics, such as the 1 year period, it has returned 71.7%, which many stocks can't boast. Simply Wall Street and their analysts currently overvalue Boohoo by 84.8% and trading at a crazy 70x PE ratio. However, with a growth stock, which in my opinion Boohoo is still definitely in its growth stage, then these metrics sometimes can be massively skewed. Therefore, in my opinion, with the fundamentals I'm going to get onto in a minute, I still think this is a great entry point for Boohoo. If we analyse the future growth forecast of Boohoo, we can see that its annual earnings growth is expected to be around 27%, which falls short of its industry, which is expected to grow 36.4%, but above the market of 20.3%. Also, its future revenue growth is expected to be 18.5%, which is greater than its industry and the market, which are expected to grow 12.8% and 3.6% respectively. This is also supported by the earnings and revenue graph, which shows the forecasted rapid revenue growth and also the steady increase in its earnings. Looking at its earnings per share, this is to grow exponentially in the future, and with this sort of growth, this should also be reflected in its share price as well. Analysing Boohoo's past earnings, we can see that over the past 5 years it has returned 34.5%, which is double than that of its industry, which returned 17.7%, and also beat the market of 13.2%. Also, over the past 1 year period, Boohoo has returned an amazing 68.2%, which in the industry it finds itself in saw a negative return of 7.2%. Boohoo also smashed the market as well, which only returned 2.8% over the same period. If we now look at Boohoo's financial state of play, it is very impressive with both its short-term liabilities and long-term liabilities covered by its short-term assets. Looking at its debt-to-equity ratio, we can see that it's impeccable at 1.5%. And this debt is easily covered by its operational earnings. So that wraps up Boohoo, as it doesn't pay a dividend, which in my opinion is one of its few downfalls. However, it is very much a growth stock, which is reflected in its revenue and earnings growth, and one in my opinion should be bought and held for its capital appreciation. The next stock I have on my list is Howdens Joinery Group, which has the ticker symbol HDWM and is listed on the London Stock Exchange. Founded in 1995, Howdens has more than 500 branches across the UK and Europe that sells kitchens, joinery, hardware, tools and bathroom cabinetry. If we take a look at the 1 year chart of Howdens, we can see that its share price was on a steady rise over the year until it hit its 52-week high of £7.33 back in February, before the market saw a fall. At the time of making this video, it is trading at a price of £5.90 per share, which is a discount of around 20% in comparison to its 52-week high. Moving on to shareholder returns, we can see that over a 5-year period, Howdens has returned 28.5%, in which the industry it finds itself in saw a return of 40%. However, Howdens did outperform the market, which only returned 12.9% over the same period. Simply Wall Street and its analysts currently overvalue Howdens by 16.7% in comparison to its fair value of £5.50, and it also has a price to earnings ratio of 16.84. However, in my personal opinion, I once again still feel like this is a great entry point to get involved in with Howdens. As I previously said, it is 20% off its 52-week high, and with the other metrics I'm going to cover shortly, it is a really great stock with a lot of potential. Moving on to Howdens' forecasted annual earnings growth, we can see that it is expected to grow 4.3%, which is slightly better than its industry of 4.1%, however considerably lower than the market of 20.3%. However, in terms of its forecasted annual revenue growth, it is forecasted to be 3.6%, which matches the market and also slightly better than that of its industry, which is expected to grow 2.7%. So despite these figures not being much to write home about, we can see that its revenue and earnings have steadily been on the increase, and despite a dip predicted in 2021, this will continue its trend in the future. This is also reflected in its earnings per share, which, with a rising earnings per share, should result in an increase in its share price as well. So moving on to Howdens' past growth analysis, we can see that over the past 5 years it grew 5.1%, which lagged both the industry and the market, which grew 12.9% and 13.2% respectively. However, over the past year, Howdens has outperformed both of these, growing 9.8%, which simply Wall Street considered accelerated, and in comparison to its industry, which grew 7.8%, and massively outperforming the market, which only grew 2.8%. This data is better represented on a graph, and as you can see, its profit margin was also better than that of last year as well. If we now look at Howdens' financial state of play, it is very impressive with both its short-term liabilities and its long-term liabilities covered by its short-term assets. This is such a safety moat in times like these and very comforting for its shareholders. What's even better is that Howdens is debt-free and has rising equity, which was sat at 615.2 million back in December 2019, leaving Howdens with an impeccable balance sheet, which will give it a major advantage in today's market. Now finally moving on to Howdens' dividend, it currently has a yield of 2.2%, which isn't amazing, however is respectable and is above its industry average of 2%. However, one negative with this dividend yield is that it is expected to fall to 2% in the next 3 years. Looking at the stability and growth of this dividend, we can see that Howdens has grown and increased its dividends over the past 8 years. However, this dividend is expected to be cut in 2020/2021, showing that its dividend isn't stable. Finally, to wrap Howdens up, it currently has a current payout ratio of 37%, which is very low and is forecasted to drop even lower to 36% over the next 3 years, which shows that its dividend is well covered and most likely won't get cut altogether despite its recent suspendment. Finally, the last stock I have on my list is BAE Systems, which has the ticker symbol BA. And is traded on the London Stock Exchange. BAE Systems is the UK's largest defence and security company. They employ over 34,000 people and work with more than 7,500 British companies. They design, manufacture, upgrade and support combat vehicles, provide ammunition, precision munitions, artillery systems and missile launchers to a global consumer base. So starting with BAE's share price, over the past year we can see that it was having a good year until the markets dropped in February and was at its 52-week high of £6.69. At the time of making this video it is trading at £4.96, which means that you can get BAE on a discount of around 25% in comparison to its 52-week high. If we now move on to its shareholder returns, we can see that BAE has returned 18.7%, which is just under double that of its industry, and greater than that of the market, which returned 12.9% to its shareholders. Simply Wall Street and its analysts currently undervalue BAE by 47.4% in comparison to its fair value of £9.44, which is a huge discount for a company like BAE, with not only its size but also its performance metrics. To further reiterate its value, we can look at its price to earnings ratio, which is a very impressive 10.7, beating the market and its industry. When it comes to BAE's forecasted annual earnings, we can see that it is expected to grow 3.8%, which lags its industry of 6.7% and the market of 20.3%. However, in terms of forecasted revenue growth, we can see that BAE is expected to grow 7%, which is slightly greater than that of its industry of 6.3% and almost twice that of the market of 3.6%. BAE is a well-established company and has been around for 20 years. Therefore, rapid growth of earnings and revenue are most likely a thing of the past, but it still boasts a steady revenue growth along with earnings which make BAE a great buy and hold stock. Analysing BAE's past earnings, we can see that over the past 5 years it has returned 10.6%, which is almost 4 times that of its industry, which returned 2.7%, but fell below the market of 13.2%. However, over the past year, BAE is in a league of its own, returning a whopping 47.6%, which smashed both the industry and also the market, which returned 8.3% and 2.8% respectively. If we now look at the financial position of BAE, we can see that it covers its short-term liabilities of 9.1 billion, but doesn't cover its long-term liabilities of 11 billion, which will need to be weighed up before we decide whether or not to invest in BAE. Looking at BAE a bit more deeper, it does have quite a high debt to equity ratio of 62.8%. However, on a more positive note, this debt is well covered by operating cash flow and its debt has significantly reduced over the past 5 years. Wrapping up BAE's analysis with its dividend, we can see that it has a very impressive yield of 4.68%, which is greater than its industry average of 4%, and BAE's dividend yield is also forecasted to grow to 5.1%. Looking at the stability and growth of its dividend, we can see that BAE has paid a dividend and increased it for over the past 10 years. Finally, BAE has a current payout ratio of 50%, which is forecasted to remain over the next 3 years, which shows the dividends are well covered by earnings. So that wraps up this video on 3 UK stocks to buy now. Leave a message below whether you own any of these stocks or if you plan to purchase them in the future. So thanks for watching. If you've liked the video, please drop it a like, subscribe if you want to see more content like this, and if you've missed any previous updates, there will be a link to the playlist along with some other videos in the description down below. And until next time, peace.